Eric Muathe with Muathe.com. Let's take a look at the crude oil market action, and we can see it was trading at 105 middle of 2014, but by the end of the year it was trading at 45 and below. So this period here can be considered a crash in the crude oil market, and we can see that that makes a lot of sense from what we are learning here about the RSI giving us a sell signal. Is we can see we go back to 3-year break. The break in crude oil to 3 years took place somewhere here, which was during this drop here at 95. So there was your sell signal from the ultimate Muathe sell signal with the RSI moving to 3-year lows. We also see another plunge by the RSI back below 38.2 on the monthly chart. So there was your minimum requirement, and hence the drop and the significant drop in the crude oil market. We can also see that at the same time the MACDs were also making fresh lows to 3-year lows. So there is your move to 3-year lows on one of the MACDs, and on the main MACD you can see that there was a move to 3-year lows, and also to the MACDs moving below 0. So that crossed below 0, and we can see here that the RSI was already trading at 3-year lows. Here corresponds with the market trading here in the 90s. So now the question is, was there a way to tell that this was a high here at about 105? And I believe there is a way you could have seen that this was some resistance and the market was poised to go down. Yes, you would not have predicted the steep drop, but at least you would have been aware that this was a major high, and at least to get out of the crude oil market. And that's why we were avoiding the crude oil market at this level. So let's go to a longer term monthly view, and here's a monthly chart going back to 2007, and we can see coming off this high in 2011 there was an RSI break somewhere there. So that break point was important because since then it hasn't seen these highs. So we draw a simple straight line like that, and you can see ever since then, every time it stalls on the same line, it has a reversal lower. It stalled again here middle of 2013, which is here, and we had this small drop, and then we came here, we saw double top on the monthly RSI, which gave us this top and also eventually this top. So there was your red flag that this here was a level to watch for a reversal. So yes, using the uniformity method, this could have given you a warning signal that crude oil was due for a pullback. Now on this chart we can see that there was another drop in 2008 by the crude oil market, given that it came from 147 all the way to under 35 in about 7 months. So that was also a crash period. So let's take a look at that crash period, and you can see here, so we are showing that crash period in 2008 right there. And more so, take a look at this plunge, this big drop from 100 all the way to $60 within that 1 month, and we can see that is when the RSI moved to 3-year lows at that point, so which corresponds with this RSI move to 3-year lows there. It also corresponds with the RSI moving below 50 on the monthly RSI time frame. We can also see another move right there below 38.2, which just 38.2, which accelerated the move lower. So all this was suggesting that this market was in trouble in late 2008. We can also see that the MACDs were showing sell signals, as you can see here, moving to 3-year lows. and also dropping below zero on that MACD time frame, which corresponds with this period here. And if we go lower, we can see also that the main MACD would soon follow, as it also dropped below zero and also to 3-year lows. So the minimum requirements were met by the crude oil market in the crash of 2008 and also the crash of late 2014. Eric Muathe, good luck, peace, and blessings. Woo!